this computer. There we go. Okay. So we lost a couple minutes at the beginning of the presentation. So the in terms of what's happening with Corona is that we're seeing a couple different policies that are coming together, in this kind of constellation. One is that there's a massive influx of new cash into the economy, which will be distributed into the hands of the general population. Now, this is to compensate people for the fact that they're under economic strife during this crisis, which is completely reasonable and definitely appreciated. But what we know, at least from historical times when there's been an influx of new money, primarily through printing, that we end up in a situation where the actual buying power of the dollar, or in our case, the shekel, is diminished. And that can happen over a relatively short period of time. And the first way that we see that is that we'll end up with shortages of products. Because if everybody has money in order to be able to buy something, that could be eggs or butter or other things that we have experienced in Israel of shortages. But when there's an influx of cash, then it manipulates the natural impact of supply and demand, which will then create the shortages. And then once there are shortages, then it creates price spikes. So
well, I don't know if I would say that there's a definitive outcome, because there's a lot of cross current forces happening within these economic crises. So you also have, in some cases, you have loss of demand, you have deflationary forces and inflationary forces at the same time. But without getting into it, let's just keep it simple and show that there's unprecedented economic stimulus happening right now. So the Fed has a balance sheet that just passed $5 trillion. That means that the Federal Reserve has purchased assets in the open market. The Central Bank of America that creates the currency in the last economic crisis took an unprecedented step of actually going into the market and buying things like mortgages, which they had never done before, in order to prop up the market from collapsing so that banks would not fail. And so the balance sheet of the Federal Reserve, the amount of assets that they hold, is now just topped $5 trillion. And they just announced, that's the first time in history, and they just announced they're going to double that in response to this crisis. And the Central Bank of Europe is doing the same thing. They announced a $750 billion stimulus with no limit on the policy. So the immediate impacts are not necessarily known, but what we do know is that this is definitely deteriorative over the long term. We know that before World War II, Germany had a hyperinflation crisis. There was, people were walking around with wheelbarrows of cash because their money was worthless, and that was one of the things. The economic crisis that they saw as a result was one of the things that led to Hitler coming to power. Yimach Shemo. So basically, there's a lot of secondary effects which can occur as a result of these sort of unprecedented policies.
And one of the impacts that we anticipate, which is not financial advice, is that we're going to see the stimulus positively impact the exchange rate between a number of cryptocurrencies and more common currencies like the US dollar and the euro.
I would just say that the reason that these currencies came into exist is to give people a free market alternative, which is not subject to the manipulation of governments. So the goal is to be insulated from if you have, like, for example, when the Federal Reserve went off the gold standard, it was illegal to own gold privately, and they could mandate that, and they could control that because it was a physical good, and they could crack down on the usage of gold within the economy. But when something is digital and has the properties that these cryptocurrencies have, it's much harder to censor. So really, they came to exist to give the people a opportunity to fight back if there is a situation where it's needed. And so what we're seeing right now is there a potential for that reality to occur. So this is
go for it, Michael. Keep going.
And by the way, there are many uses for cryptocurrencies. We'll get into that. It's not only for this use case, but and blockchain and all of that. So we'll get into that. But we wanted to just give a general overview of the motivation behind Bitcoin, which was the first example of cryptocurrency. Still the bellwether and the proxy for the whole market. And so we'll give a general overview of the whole history of the space. So here we've overlaid the chart of the price of all of the cryptocurrencies and digital assets, and comparing it with the internet between 1994 and 2004. So we have about 10 years history now. We showed 7 years here of the price history of cryptocurrencies. And as you can see, it very much mirrors technology stocks between, during the era of the inception of the internet. What we saw was that we had a very promising new technology that went through a hype cycle, and everyone went crazy trying to invest in the future. And then people realized that, the future vision was far away from the reality. The market corrected. And then we had a period of sort of downward sideways movement where the market, these assets fell out of favor. The investment opportunity, it fell out of favor. But that was the period that, the most promising entities of the future really were being built. So, during 2004 to 2007, we saw Google IPO, we saw Amazon launch Prime, we saw Netflix launch its streaming service. So these became the massive companies of the internet. And during this time, the NASDAQ was well below, the price of technology investments was well below its highs. So this was the opportunity really for investors and for entrepreneurs to start focusing on this sector. And so we think that there's a very similar dynamic at play with crypto and blockchain technology right now.
Okay, so what do we want to run through? That was kind of the background. Is we're going to talk about what's Bitcoin, a little bit how it works, what makes it important. We addressed that, when we talked a little bit about the impact of money printing on society. What's Ethereum and how did it expand on Bitcoin? And what are the opportunities beyond Ethereum? And there's a specific project that we're very excited about that it's called NervOS. It's a smart contract. It's a programmable distributed ledger that we'll get into exactly what that means. And it launched a little less than 6 months ago, and it addresses some of the shortcomings of both Bitcoin and Ethereum. And we feel like there's a lot of great opportunities to build in this space as an entrepreneur and as an investor. And so we'll go through some of this. As we said, Bitcoin came into existence in 2009. It was invented by Satoshi Nakamoto, which was probably a group of people. And it really it solved the problem of double spend, meaning that if I have a digital good, like I have an image file on my computer, I could send that to Michael, and then I could also send that to Dan or to Ben. And so there's no such thing as digital scarcity. So really Bitcoin invented digital scarcity, and that's expressed through the 21 million supply limit of Bitcoin. There's only 21 million Bitcoin. The Bitcoin can be divisible into very small amounts. You don't need to, just like with a dollar, you can break a dollar down into pennies. So a Bitcoin you can break down into the penny equivalent, which is called a sat or Satoshi. And it's the reason that it's called blockchain is that every 10 minutes on Bitcoin, another block, which is the history of transactions, is added to the public ledger. Even though it's 11 years old now, Bitcoin has had its fair share of difficulties, but remarkably, it's come away from each of those more robust and resilient. Well, when we saw in the price went from $1,000, from $100 to $1,000 in the span of 2 months, that was really arguably the first major bull run. And then ultimately in 2014, it crashed when the most popular exchange, which was a place that you would buy and sell it called Mt. Gox, was hacked. And then that point, that caused arguably the first crypto winter. which was from roughly 2015 until the early 2017, which most of us in the general world are familiar with Bitcoin from, or crypto in general, from that time period. Micah, you want to talk a little bit about what happened during that down run?
Yeah, so probably a lot of people who've paid attention, who are interested in technology, have heard the phrase, I'm interested in blockchain, not Bitcoin. And that's a way of saying that narrative and phrase came into existence in basically 2014, 2015, in response to the crash of the price of Bitcoin, where people thought to themselves, maybe this thing isn't going to be so significant as an investment opportunity, but maybe the technology underlying it could be used in corporate settings or for other things. And to date, actually, there really haven't been any examples of that. Because really it's just a database which is maintained in a distributed way. That's really what the blockchain means. And when you're talking about using the technology in a private setting, you already can use a database in a private setting. You don't really get any benefit out of that. The whole benefit of this technology is having the open access to anyone around the world, just like the internet gave open communication abilities to anyone around the world. And the internet that people had inside companies really kind of fizzled out. People don't really use intranets too much anymore, and so it's sort of a similar comparison there in our view.
Okay, so one of the next most interesting thing that happened was while Bitcoin is essentially a spreadsheet, it's a spreadsheet that's run on about 60,000 computers. And it can perform operations that you're familiar with that a spreadsheet can do. You can move values from one column to another column, or edit rows. You can review histories. It's not really a full computer. So in 2014, a guy named Vitalik Buterin began to launch a platform called Ethereum. And Ethereum was based off of Bitcoin, but it said, instead of building purely a spreadsheet, let's build a whole developer environment where any piece of software can be created. It can be run on thousands of distributed computers, and it can manage not just the ledger of one type of currency, but it could actually manage many different types of things. So common use cases for that would be things like stock of a company. Instead of issuing stock of a company on something like the NASDAQ, you could actually issue it on Ethereum. You can create synthetic assets like US dollars, which then you could build on top of Ethereum as the database to create a product similar to Venmo. You could register things like events or ownership of property, deeds, anything that can be issued today or would be issued today, and by an authoritative source like a government, you could now issue it in a public setting and the advantage to this is that when you issue something on Ethereum, you know that there is nobody that can come and can mess with the spreadsheet or mess with the software. What you see is what you get. And while we're still at the very early stages of what exciting things can be built on a smart contract public blockchain like Ethereum, we have seen over the past roughly 2 years many exciting applications that have come out and are currently managing over $1 billion worth of assets.
By the way, we wanted to keep this open for questions. So if anyone has any, want to keep this interactive, if anyone has any questions, please feel free to put in the chat there. And we'll
a lot of information that we're going through, and the idea here, our goal in this presentation is really to give a high level and to see what areas of this industry might spark your interest. And then we're happy to, we've got a WhatsApp group and a Telegram group that we're happy to have follow-on conversations. And if you are building a business and that business does interact with finance, and you think that this technology would be helpful, then that's really where we would love to sit down with you in more details and walk through how this technology could be beneficial to your business. So you want to talk?
Okay,
yeah, go ahead. You want to talk about the DAO hack?
So this was we tried to just highlight what were the sort of meaningful events in our view in the crypto space for the last 10 years. So without getting into too much detail, one of the first applications that was built on Ethereum was a decentralized venture fund where people basically, they gave this group of developers gave the opportunity for any remote individual around the world to take their Ethereum, which was essentially a digital currency with a market value, put it into a pool of funds, and then have the right to vote on investments which that pool of funds would fund, and then get exposure to the upside, in a collective way. So this was very experimental. This was very early, and the code that was used had some flaws in it, and some hackers were able to, and it really wasn't a hack, actually. The consensus eventually was that it wasn't a hack. It was just taking advantage of poorly coded, an exploit, were they able to siphon out these funds to a private account. And so this was very controversial because it was in the early days of Ethereum, and at one point there was $150 million of value locked into this contract. And this was a massive amount of the percentage of outstanding Ethereum at the time. So the Ethereum community decided that they would collectively, meaning all of the entities that were maintaining the integrity of the blockchain, meaning the history of the allocation of the funds,
The people running
decided
the
that,
computers.
they decided that they would reverse this siphoning event and return the funds to the original holders. And so this was controversial because one of the key values of sort of cryptocurrency is its immutability, meaning that there's no going back. Once something happens, it happens. And that's been the case with Bitcoin for the most part. But ultimately, Ethereum decided that they're trying to be more ambitious than Bitcoin. They're trying to create something with more complexity, and it was still early, and that they wanted to not hurt their roadmap and their ability to continue developing. And so they decided to go ahead and reverse it. This is all happening on open source software. And so there were idealists that disagreed with that decision, and they maintained the previous version. So that became Ethereum Classic, where the siphoned funds were continued to be recognized. And the Ethereum that is the Ethereum of today went forward with reversing that transaction. So this was just a meaningful event that still has implications to today, because you have two chains, but Ethereum Classic is much less significant in terms of activity that's happening there. Most of the community followed the new Ethereum with the reverse transaction.
So in 2017 is when things really started getting interesting, and that's when we saw earlier in the charts when prices went crazy. So there was something called an initial coin offering, and what happened here was that entrepreneurs realized that they could use the blockchain, and specifically Ethereum and Bitcoin, to act as a fundraising event for their business. And the way that worked was that they minted arguably what you could call a large number of shares of their business as cryptocurrency, and then offered a public sale, kind of like an IPO, where anybody could come in, or a Kickstarter, if you've ever used Indiegogo or Kickstarter, where people could come in and they could buy these coins, which loosely represented access to whatever software network that they would be building. So some of the interesting things that came out of that were decentralized file storage and computation, new advertising platforms to compete with Google Ads, virtual reality worlds where the actual land and the items in it were scarce, and then better and more efficient ways to build blockchains. So things like, you could argue, EOS, Tezos, Dfinity, and a number of other things. And the vision here was that we would be able to recreate the internet, but not owned by governments and by internet service providers, rather owned by people. The same way that you could argue Wikipedia is owned by the people, not owned by a government or an organization. And so the vision here is to rebuild the internet and rebuild a financial ecosystem that's borderless and uncensorable and owned by the people. Now, with this hype came, and all of these good things that I'm talking about, also came a lot of scams. And so from those scams, we saw the massive price spike and then ultimately the crash. But now that we're about 3 years past that point, we've seen the projects that have kind of grown out of the the winter, the frost of winter has had flowers kind of spring up here and there, and there's a lot of projects that we're investing in today, which we're very excited about, have shown that this technology is while still in its infancy, is incredibly useful for many different use cases. Anything that you want to share, Michael?
Yeah, this was just a highlight of how crazy the environment was at that time. Meaning that the ICO, the concept of ICO went back as far as 2013. Entities issuing tokens or coins that gave access to a network or a use case. It's the first one being on top of Bitcoin, using the Bitcoin protocol, even though it wasn't specifically designed for that. And then once Ethereum came out and made it easier to do that, you had all of these crowd-funded platforms with these visions of the future, really raising funds in a unprecedented way. So Brave, the advertising platform, what just happened?
I just went back because
okay. No, I was just reviewing that slide. So Brave raised $35 million in under 30 seconds. The highest grossing one raised 257 million, which was a decentralized storage platform. And you could see they raised 40x as much as they had in the previous year. So it was really a wild environment. And that was a result of massive promise, along with, unregulated global access to these investments all over the world.
And in terms of what we see, that the money from this stimulus package, these trillions of dollars that are entering into the market, so there is going to be a number of investors that are sitting on cash and looking for interesting technological opportunities for investment, and it is likely that the even though it may not look like it today, but somewhere between, let's say, 6 to 24 months from now, that there's going to be phenomenal fundraising opportunities within this space, possibly even ones that that surpass some of the previous highs.
Mm.
And I think that we're a little short on time, and we started pretty late, so I think let's jump.
Well, I just wanted to go through the reasons. The reasons why it crashed was because there was a lot of scams. There was no valuation method, because actually the use case for the tokens that were raised in many cases didn't make sense. We can get into that for anyone who's interested in understanding this in more depth. The regulatory environment for how to raise for these things in a compliant way was unclear, and there just weren't many products. There was a lot of vision and no execution. So those were the primary reasons. But over the last 18 months, we've seen a tremendous amount of execution and clarity on all of these issues. So we think now is a great time to start investigating how to use this innovation in the proper way.
Yeah, go ahead.
So one of the primary use cases that we see is this thing called DeFi, Decentralized Finance, which is an ecosystem of financial building blocks that has emerged on Ethereum. So we've seen people build on open source software that is running permanently on Ethereum in an uncensorable way. People have created exchanges, synthetic assets, meaning they've represented dollars and stocks. So anyone from all over the world can get access to these financial instruments through Ethereum. You have derivatives, prediction markets, insurance, basically tons of financial building blocks that can then be combined because they're open to anyone to use and create products. So anyone who's interested in creating a new business can look at what's happening here and start playing with things that are really interesting. Okay.
And you can see here some of every one of these logos here represents a company that that was born sometime between 2017 and 2020. And this while this is primarily this list is entirely built on Ethereum, we anticipate that other blockchains which offer um, potentially superior environments for building will be able to not only recreate this level of adoption, but actually surpass it.
Yeah,
And
and what we really wanted to highlight was that the primary use case for this technology we believe is financial settlement. So what does that mean? The Bitcoin network, there's two things with the Bitcoin networks. There's the network and then there's the Bitcoin. And the network is really a way of settling transactions of Bitcoin. And it just does Bitcoin. That's what it does. Bitcoin is a provably scarce digital commodity money, which anyone in the world can get access to and can be confident that the amount of, because of the security of the network, meaning the difficulty of manipulating or hacking the network because of how robust it is and decentralized it is, you can be confident that your money will be that you will be the owner of that money. And what Ethereum brought to the market was the ability to settle not just the native asset of that chain. So in the case of Bitcoin, and that's basically the only thing it does, Ethereum settles Ethereum transactions as well as any arbitrary financial asset that you could create and represent as a token. So that's really called multi-asset settlement. And we'll get into some of the risks around why Ethereum might have problems maintaining its ability to settle many assets in a sustainable way, and why we think there's opportunities for other platforms, namely NervOS, which we're excited about, and to offer that value proposition in a more sustainable way. So
with
can
new
I just
technology.
can I talk on this real quick, Jonathan?
Sure, go for it.
So when we say what multi-asset settlement, when we talk about other assets, why is it important to settle not just Bitcoin or a native asset of a blockchain? Why are other assets important? When you think about what are those assets that will be settling? So in 2017, we saw all these different networks raise funds to launch a token. And you could say that those tokens are the assets that will be settling. But in order for that to mean something, those tokens need to have value. And what we saw was that many of them didn't have value because they really were just payment tokens. They were like basically Chuck E. Cheese tokens or arcade tokens. If you want to come play my game, you need this token. But that's not really an investment asset. That's not really a financial asset. That's not really something that holds value because
Like a stock or a bond.
yeah. So what we're starting to see now is these things that are being created with open source software and leveraging the permissionlessness and the open source innovations that are happening on Ethereum, like we mentioned, these exchanges and insurance and lending and borrowing and prediction markets and all these different things that are becoming building blocks of a new financial system. You can then create businesses which use these services and receive payment in cryptocurrency on these networks, and then issue an equity-like asset, which that equity will then be one of these assets that settles on these public blockchains. And so what we've outlined here is what a model for that can look like. And this is a little bit getting in the weeds, which we can explain in more depth to anyone who's interested. But we anticipate that there will be many businesses that will launch on a public blockchain, and its equity, its debt, its financial structure, and its cash flows that it will receive will all settle onto a public blockchain. And we believe that this is going to be the future financial system. And it will all reside on top of a robust multi-asset settlement blockchain.
Okay, so in short, what makes blockchain useful, especially during times of financial global financial instability, is that they are censorship resistant, that you know what their monetary policy is, you know how much of them there are, so you know what percentage of the total issuance you own. They are flexible enough that new businesses can create new assets on them. anybody can come and use this technology. It's all open source. And any two businesses that are both using this financial technology, they're de facto compatible with each other. The same way that if I build a website and you build a website, our websites can be, they're on the same infrastructure, so they're compatible with each other. That's not the case between, let's say, the Bank of England and the Bank of America. That we really have to, jump through hoops in order to get those two banking systems to talk to each other. This standardization simplifies that. And we're also very excited about real businesses with profits and employees issuing their entire financial system infrastructure on these platforms. And what we're not so excited about is using this technology kind of as a buzzword, or using it in a private setting where you lose the permissionlessness that comes through having tens of thousands of people validating the transactions all over the world. Now, while Ethereum is the most popular platform in order to be able to create these businesses, Ethereum does have some non-trivial risks. And those risks are primarily focused around the fact that the native token, which provides security and stability to the network, which is the ticker of it is the ETH token, that it is not directly linked to the value that's being created by the businesses that are built on top of it. This is somewhat of a tricky concept to understand, but when Ethereum was envisioned in 2013 and 14, there was a lot less clarity as to what types of businesses would be built on top of it. And there was a lot of thought that the businesses would be primarily transactional. So the way that the ETH token gets its value on the public Ethereum network is through transaction fees. That the more transaction fees that you have, the more ETH that you have to pay to the operators of the network. The problem is that for most businesses, they're not high throughput businesses. They're actually high value storage businesses, meaning that a company like you could take a lending company, for example. So they might perform billions of dollars worth of transactions, but they're not doing that through micropayments. They're doing it through large payments. Like if you think of what your bank does, even though you might use your bank and withdraw, 100 shekels or 200 shekels from an ATM, actually the majority of the transactions that a bank is performing are mortgage payments, and mortgage payments happen few and far between, and they happen in large volumes. So really what we need is a smart contract settlement layer, which is designed to make a profit based on financial businesses that will be built on top of it. And Ethereum,
I would say more that large value assets are being secure, are settling to that chain. So meaning the balance, a large amount of value, a checking account with $1 billion or a mortgage worth, millions of dollars, that these high value assets will be stored in this, so to speak, bank of the public blockchain. That's the primary use case for the way I would say it is not that the business itself shouldn't be high throughput, but that the actual use case for that permissionless lowest level layer is really the storage of the assets, and that the reason for that is that it's very difficult to have a distributed consensus, meaning a broad group of people around the world validating the integrity of that database, and have that also reconcile with high volume transactions. In order to have high volume transactions, you need to have basically one mega computer running everything. And if there's one mega computer running everything, then you don't get the benefit of having a large distribution of people validating the activity. And so if the goal is to keep this open to the whole world and for everyone to see what's happening, you need that wide distribution of validators. And in order to have that, it reduces the throughput capability. And so because of that dynamic, really the base layer should be doing storage and not transactions. I hope that was clear.
And one of the challenges with Bitcoin, well, there's two main challenges with Bitcoin. It's Bitcoin is not designed to have businesses built on top of it. Bitcoin is really designed to have 21 million Bitcoin that are transferred on its network. And while it's possible to build other things on the Bitcoin network, it's really built in somewhat of a hodgepodge manner. One of the other challenges to Bitcoin is that the transaction fees on Bitcoin have to be high in order to provide strong security. Meaning, if the miners that are maintaining the Bitcoin network are not compensated financially, then they will not be inclined to secure the network. So what we've seen to date is a positive correlation that the more popular Bitcoin becomes, the more expensive transactions become on that network. While this is great for a global settlement layer like a digital gold like Bitcoin, it's not great if you actually wanted to build a consumer product or a B2B fintech company on top of it. So what that brings us to is, is a public network that's called NervOS, which has a token called Common Knowledge Base, CKB, which is designed to be a sustainable multi-asset chain. And it is a public decentralized blockchain similar to Bitcoin. It is multi-asset, meaning that a business can build their own assets on top of it and can run their own code on top of it, like Ethereum. But the economics are built much more in line with the concept of a fintech startup successfully building on this network. And the more successful that fintech startup becomes, the more secure the underlying layer beneath it, the CKB layer, becomes as well. So it really has taken, CKB has taken the best of the Ethereum network and the Bitcoin network in order to be able to provide a powerful network layer for any fintech startup to be built on top of. What do we got here?
That's
okay.
a link to a video.
Got it. Okay, so you want to talk a little bit about the opportunities for building in this space?
Yeah, so really the playbook here is that NervOS is trying to build out the DeFi, the decentralized financial stack that started to emerge on Ethereum. And so it's very clear what are the applications that need to get built out. And they have a $30 million grant program to do so. So they've raised a bunch of money from, top global VCs focused on this space.
Including
And
ourselves. We participated in investing in it before it actually launched, and we've been very, happy with the progress that the developers have made since they went live.
Yeah, basically the way we came to this project was that we've been very bullish on the whole value proposition of crypto as a future financial system built on sound financial principles, the way as encapsulated by Bitcoin. But we constantly, Jonathan and I sit and argue with each other about what are the risks and what's interesting in the space. As that's what we do as part of our research. And so the main risk that we came to with Ethereum and Bitcoin, we found addressed in a very clear way with the NervOS architecture. So it's a much earlier stage project, which puts it at a higher risk in some regards, but also with great opportunity because it's a much lower valuation. Anyone who gets in and starts building right now has the opportunity to, there are applications that exist in other DeFi ecosystems, which are very high value at this point and raised hundreds of millions of investment that could be recreated in a more sustainable ecosystem. So there's a ton of opportunity here to rebuild and then build, and then take this chain and continue the momentum with a sustainable ecosystem because of its ability to raise security with the value of assets. What we didn't describe is how exactly that risk plays out in a ecosystem like Ethereum, where if the value of the assets that are settling to the chain becomes too high relative to the Ethereum value, that becomes an attack vector. It just hasn't been relevant yet because we haven't seen, we're still early, but if anyone's interested, we can, it's a little bit complex and could take time. So we could describe that offline to anyone who's interested.
So in short, first of all, thank you. This was a pretty heavy presentation. So there was a lot of material that we wanted to cover. We thank you for your patience and going through this with us. We're available to answer any questions. If you're running a business that you think could benefit from any of this technology and you would like to see if you're eligible for the $30 million grant program, we're more than happy to help walk you through it and to even help you prepare a grant application. In short, there's whenever money is whenever there's an influx of money, there are new opportunities and new opportunities for building and new opportunities for investing. So
I wouldn't say there's a definitive outcome that will come out of this whole situation, this whole financial crisis. I would say that crypto was built specifically for this environment where the impact of central banks and governments has become limited and unreliable, and this is a open source, transparent system to run a financial system on top of. And we believe that this is what the future financial system will be built on. And we're just in the early days, and now is where the exciting opportunity to actually be the pioneers that build these businesses of the future. This is the time to get in, and this is the environment that it was made for. So what the financial return will be in the next 6 months is hard to say, but in general, we believe it's going to be incredibly valuable in the years to come.
Okay, and we're happy to take any questions if anybody has questions. I don't know if anybody can come off of mute. Let's see. I think we're still scarred from the terrible first.
I didn't mute everybody, but let me see.
Yeah.
No, people.
Yeah.
Yep. Okay. Any questions? And if there's no questions, that's fine. Also, it's we're happy to have one-to-ones if people think that might be more effective.
Somebody's typing in here.
Yep, we got some thank yous.
Okay. Thank you guys for paying attention or just being on the line, I guess.
Yep, and again, if you are working in anything in some specific areas that we'd like to see, are marketplaces, aid programs, ways to distribute money more fairly, lending platforms.
Also gaming. There's we think that the first businesses that will really benefit and build on this technology will be businesses that are fully digital, meaning don't interact with the physical world too much. So video games will be a clear use case for this because you can issue in-game items that are provably scarce. So if I have a shield, we've seen a massive $100 million market emerge around video games and tradable items. And in this place, in this environment, you can create in-game items that are provably scarce and also transferable between games. So there's a lot of innovation that can take place. And we think that gaming, for anyone who's interested in that, will be one of the areas that will drive mainstream adoption of this technology. So anyone who's interested in that, that's a whole separate discussion that we'd be happy to have as well.
All right, guys, that's all for now. We'll be in touch. Look, if you want
Thank you so much.
If you want a copy of the deck, you can get it either from myself or Michael or Alyssa.
Yeah, and we're putting together a blog post that will review some of this information. So we'll be happy to share that link as well shortly.
All right. Have a good day. Everybody stay safe. Wash your hands.
Thanks a lot.
Yeah.